Commercialization of variable recurring payment through open banking has been a subject of conversation across the payment ecosystem, especially among financial institutions that have made significant investments in infrastructure over the years. Experts are of the opinion that cVRP is one of the biggest steps in bringing open banking into day-to-day use. However, its success depends on whether the business model makes sense to everyone involved, that is, the bank, the fintech, the biller, and ultimately the user. To help move things forward, Open Banking Limited recently, in partnership with Frontier, shared a proposed commercial model, what they call Wave 1 of cVRP, to guide on how pricing should be set between the sending back and payment initiation service provider (PISP). Welcome to Payment Crunch. My name is Noah Oyenei, and in this video, I will walk you through the key takeaways from the recently published Wave 1 commercial model, what it means for banks, PISP, and the broader payment ecosystem. cVRP is an open banking enabled feature that allows authorized business to collect recurring payment directly from a customer's bank account. Think of it as our usual direct debit payment or subscription payment. But unlike direct debit, cVRP offers real-time transfer, greater transparency, and customers get to set the parameters as they like. The published Wave 1 model focuses on low-risk use cases like payment of utilities, government services, donation for charity, and financial service compensation scheme products, as this lay foundation for broader layout. The challenge with cVRP isn't just technical, it is commercial, and for it to scale, banks must be willing to invest. Payment initiation service provider must be willing to onboard merchants, and ultimately, end user must be able to see value in its adoption. So the proposed model needs to create the right incentive across several value chains. According to the report, two pricing approaches were explored: a value-based model and a cost-based model. The cost-based model was chosen in the Wave 1, focusing on cost recovery and fair return. With the adoption of cost model, the idea is to keep the pricing simple. Therefore, payment initiation service provider will be charged instead of the customer. This is to support rapid adoption. Also, the pricing will be fixed per transaction and all participants pay a single market price, making things transparent and fair. The pricing is expected to fall somewhere between 3 pence and 11 pence per transaction. Although with this price, direct debit remains cheaper and cVRP won't beat it at cost, but it can compete with card payment, especially on high value transactions. So the sweet spot is between 6 to 8 pence, which is competitive enough to attract merchants while offering banks a reasonable return. While lower prices may drive adoption, it poses the risk of under-incentivizing the banks. Higher prices tend to discourage merchants. Therefore, prices between 6 to 8 pence range is seen as commercially sustainable. This Wave 1 commercial model gives us a first look at how this might work. And it is interesting to see how banks and fintech respond to this wave. Do you think this pricing model is enough to drive adoption payments through cVRP than direct debit and card? I would love to hear your thoughts in the comment section. And if you find this episode helpful, like, share, and subscribe to Payment Crunch. And until I see you next time, stay curious. Thank you.